Hey, good morning, everyone. Marty Mazzora here. Sunday morning, 22nd of January, 2023. I was out of the office Friday, so this is your economic update and your stock market snapshot. Going to do it backwards this time because I just updated our technical screens on a bunch of stuff, but I'll just look at the S&P 500 with you, and then we'll do the economic update at the end. In front of you is the daily chart of the S&P 500, and not a lot really to talk about. I know it was quite the week last week. The S&P actually closed down on the week, about 0.75%, but we had a rip-roaring day on Friday. You can see this big positive candle here. That's Friday. Closed just a hair above the 200-day moving average. That's technically positive. Remember this consolidation rectangle right in here that we drew, where we had multiple days of just this range, and it was looking pretty good for a breakout to the upside. If you look at the bullish divergence on the RSI, we did that, came down and tested right about the top of that range. Okay, and that's actually positive as well, right? That's coming back to what was previous resistance and it becoming support. So closing above the 200-day moving average, bouncing off of that now support line, looks pretty good. Also recapturing the 50-day moving average on Friday as well. Noticing here though that, again, we bumped our head against that bear market trend line, and maybe perhaps we'll do it again this next week. Nothing really to report here on the momentum indicators. Still have what I think looks like a reverse head and shoulders that, our base case says will fail. We could definitely, break through this trend line. We do have multiple layers of resistance for sure. Okay, obvious ones here are the downtrend line and the 200-day moving average. Okay, so that's just barely closed above that. Really strong resistance here on the 200-day moving average. When I move this back a little bit, we can capture the whole bear market to this point and look at the retracement lines. And that's interesting to view as well. So the 38.2, the 50, and the 61.8%, those are the key technical retracement levels that technicians respect the most. So you start at the top. The whole bear market at this point has been from 4,800 plus right down to what was our original bear market target of 3,500, right on the nose in October. So we're retracing back. Now we're at 38.2, which, as you can see, has been a pretty important level since we bottomed here. So we came up, retraced 38.2%, and then bounced against it and have just continued to threaten to overcome it and then ultimately fail it. And it pretty much has been pretty strong resistance. So now you've got that. Again, this magnet of the 200-day moving average, perhaps pulling back if we get above that again. And then you've got the downtrend line. So again, a lot going against the market technically. However, this upward sloping 20-day moving average, breaking the 50-day, coming up there. So you've got quite the push and pull, technically speaking, at least on the price chart. Momentum indicators look okay on the daily. On the hourly chart, remember I said that we had a very bearish look right in here. I think it was our last report last Wednesday. We extended that rising wedge pattern. We had bearish divergences here. Sure enough, broke down below that with force. That was an easy call to make against this resistance level here. But again, bounced hard with some real momentum. You got a buy signal here on the MACD and so forth. Basically, the momentum is moving with price, and we'll see how she goes. We've got 40.20 is really stiff resistance, I think, right in here. That 4,000 mark, which for options, quite the magnet with regard to where dealers are positioned and so forth. A lot of those options expired last Friday. And so, again, remember, if there's lots of put exposure out there, the dealers are short the underlying securities. As those puts are closed or expire, well, then they cover those shorts, and that could have had something to do with this big, massive rally we had on Friday. Also, with regard to short interest, I thought I'd show you our weekly look at the commitment of traders reports, looking at the non-commercial traders, essentially speculators. This is the S&P 500 E-mini contract. Notice that last Tuesday, so these are updated on Tuesdays, we had quite a bit of short interest in this market. So that's important because shorts are really exposed to an upside move, meaning they borrowed securities, sold them, they've got to cover those shorts. They have to give back what they borrowed in terms of the shares. And if the market moves against them, they have essentially unlimited loss potential. So going into Friday, right, we had some pretty notable short interest there. On the NASDAQ, we had a big spike in short interest. And of course, the NASDAQ had the biggest update on Friday. So folks, I think it's safe to say that Friday was largely a short covering rally, maybe more so than anything else. And you can see the Dow week over week had an increase in short as well, and speculators have been net short the Dow for quite some time. So this is actually fodder for short-term traders, bullish traders. I like setups where I'm looking at a security that I may be bullish on. You love it when there's high short interest, because obviously if you're right, then the shorts are wrong. And if the market starts moving in your direction, then the shorts cover and push things up. So I would be cautious. A lot going on next week to keep our eye on. But the technicals right here are, I guess you can make a case in both directions. Our base case is that this bear market probably has another leg lower in recognition of, recessionary conditions and earnings coming in ultimately worse than what's presently discounted in stock prices. So we still think caution is warranted right here. Okay, so let's jump into our economic update. Our index stayed flat at a negative 33. Week over week, there was actually quite a bit of jostling around, both positive and negative, but when you square it all up, the score remained the same. Still very much, by our estimation, in recessionary territory, meaning the odds of recession are notably higher than the odds of continued expansion going forward. As I remind you every week, we remain in what we'll call the mild recession camp at this juncture. Okay, so retail sales came out last week, and they continue to decline, particularly on the Red Book reading. This is a weekly read, and it's the rate of change, the growth rate continues to decline, up 5% on a year-over-year basis last week. And sales look relatively flat, down 1% on a month-on-month basis, relatively flat on a year-over-year basis. And keep in mind, as we talked about when retail sales were ramping up, of course, these are nominally based. So if prices drop, you actually could have the same amount of unit activity. But if prices drop, it's going to show lower retail sales. So there's some of that in there, but for the most part, weaker retail sales. Mortgage purchase applications really popped this last week. Now, mortgage rates have continued to come off the boil a little bit, so that's probably a positive. Looking at Peter Bookvar's notes, he suggests that post-holiday behavior is very poorly adjusted for in terms of seasonality by the Mortgage Bankers Association. So essentially he says, take it with a grain of salt for here and wait until next week to get a legitimate gauge for the market. So we'll go with that for the moment because that was a really big jump on the week. Housing starts came out last week. Now they were down overall, but we also dig a little deeper into single family. And notice actually single family starts saw quite the pop. And again, you could talk about, coming off of the Christmas season and lack of activity and so forth. So we'll see, but that was an impressive move up in single family starts. Now, we also want to pay very close attention to permits, right? Because permits precede starts. So that should give us a view of what to expect perhaps going forward. And overall, they're down. And single family housing permits continue to slope ever downward. So that's not a good look relative to the near-term future for single-family housing. Weekly jobless claims below 200,000 at 190. We just had a holiday on Monday and so forth, so that wasn't in the mix. So got to look at next week, but that is just an impressive trend. If the Fed ultimately is concerned about labor market strength, well, that concern is still very much there. Hence, what I want to say is hawkish language relative to what the market is discounting, even among the most dovish Fed governors. Industrial production continues to decline, not a good sign. Rate of change down, call it 25%, down on a week-over-week basis. Very recessionary readings, particularly from the manufacturing sector. Capacity utilization, the extent to which factories are running at capacity, is rolling over. As you can see here, not a good sign relative to what tends to happen going into recession, which of course are these red shaded areas that you see in here. Commercial and industrial loans as well, rolling over. Again, not a good sign. You can see how it tends to look going into recession. The U.S. Economic Surprise Index now rolling over. So this, remember, is actual data coming out relative to what economists had previously expected. Doesn't mean we're in a recession, just means that the data is coming in worse than economists had anticipated in the US. And I want to specify in the US because when I look at the other ones that we track, it looks pretty impressive, right? The Eurozone, positive 88. So Eurozone data is coming in way better than what economists had expected. Japan, notably better than what economists had expected. China, way better than what economists had expected. Emerging markets in general, better than what economists expected. And the global surprise index, notably better than what economists have expected. So folks, what have we been preaching here for quite some time is that we think the next bull market is going to be one that favors non-US securities over US for a variety of reasons. And the economic setup speaks to our fundamental view that there's more opportunity going forward outside the US and our fundamental concerns about the US economy. But when you look at this, when you square this all up, think China perhaps in particular, remember our mild recession thesis is partly predicated upon China really forcing a ton of stimulus into their own second largest economy. And make no mistake, that is a not small factor relative to what we're seeing in the rest of the world right here currently. Producer prices came out this last week, month over month, down 0.5%, year over year, it's 0.24%. Absolutely what we should expect in a slowing economic environment, but still historically exceedingly high. And then lastly, but certainly not leastly, the price of copper continues to soar, although it is off a little bit. There's a downtick here. You can see we got up to like 94 something, down to 92.32. As you know, folks, clients and regular viewers, we are long-term very bullish on copper. However, this sort of chart is the definition of unsustainable. So copper will ultimately come off the boil, or I should say this trajectory will not be what you see here. That's an easy call to make. Notice this arrow we were pointing here. So what do you see, historically, right? You see these big ramp ups and then you see consolidation periods where you just kind of digest those gains. This is all about China and all about their promises to stimulate like crazy. And this is how China does it in ways that really pushes the price of copper higher. So that just speaks to, what our anticipation was coming into this year. We do think it's going to be a very rough year. And I would be cautious right here, industrial commodities, because again, even though China is going to provide support for the economy all year, we don't think the economy is in great shape right here. And if we're right, then we're going to see things come off the boil. Clients were actually hedging some of our exposure to these areas, industrials, materials, miners, and so forth. We're doing it with relatively cheap put options right now. We're certainly still in good shape if we continue to melt higher, but we want to be in not so bad shape if indeed we come off the boil a lot. So folks, again, we think it's going to be a somewhat precarious dance, particularly through the first half of this year. We become bullish thereafter based on how we see things at the moment, but we do not wed ourselves to our theses. We do the work day in and day out, keep a very open mind to all possibilities, and just try to be very intimate with the risk reward setup. We may see big risks out there. Doesn't mean they have to come to fruition. It just means that they're there, and we need to act accordingly when the risk reward setup is, I'll say it again, precarious. We're not bearish on the year overall. We're just concerned about the near-term outlook. I'll leave it there for now. Hope you have a great rest of the weekend. Enjoy your football games, and be back tomorrow morning with the morning note. Thanks as always. Take care. Bye-bye.